If you'll pay attention for 25 minutes, I'll show you how to make $50,000 to $250,000 more dollars this year without selling one more piece of real estate or doing one more hour of work. I want to tell you about a huge problem that you have, but before I do that, I'm gonna tell you how I'm gonna solve it for you in 25 minutes. I'd recommend you probably get out a note-taking device or something, because we're gonna have to blow through some of this. How many of you know if you took a penny and you doubled it every day for 30 days? Okay, so 1 penny becomes 2, 2 becomes 4, 4 becomes 8. Double that penny every day for 30 days. What's that 1 penny now worth on the 30th day? $5,368,000. 1 penny. If you don't believe me, just Google it. It's right, I promise. $5,368,000. Now, let's wait a second. We know in a society, in a country that we live in, anytime you make money, what do you have to pay? Of course. So let's assume that you're not in California or New York, and you're paying 28% in federal taxes. So now my question to you is this. You double that penny every day for 30 days, and every time you double it, you owe 28% in taxes. What does that 28% tax do to that number on the 30th day? What's it worth now? It's worth $67,000. Let's be clear on what we're looking at. There's a $5.3 million difference with a 28% tax. So if it's not clear already, what do you think your biggest problem is? It's taxes. And here's the thing about taxes. It's the problem you don't know you have. Taxes don't just take your money, they steal your time, because your time is your money. And we all know that intellectually, but I want you to think about this. You're making a trade every single day. I'm going to give my time to this in order to receive this back. And we do that for comfort, for identity, for lifestyle. There's lots of reasons we're willing to make that trade. And that trade is leading us to not really own our time. We're like well-paid slaves to a system that we're operating in. But you also have another problem with taxes. Anytime you buy an asset and it goes up in value, good for you. That was a good decision. But then you owe taxes on it. So it's not just your money you're making in a year. It's the money you're stuffing into retirement accounts, and it's the assets you're buying while you try to create financial freedom. You've got tax problems all the way down the line. And as John said, your solution is this: just make more money. That's not the right solution. Making money has the same addictive qualities as opioids. What do opioids tell you when you're using them? This is good for me. This makes me feel okay. I need to do more of this. Our solution is let's keep more money. I want to give you solutions that you can stick in your pocket and take home with you on how to solve each one of those problems. All right, number one, income tax, meaning the taxes you pay your federal, state, and local governments in a given year based off the money you make. And there's all kinds of taxes. There's a net investment income surtax, it's 3.9%. There's local taxes. There's FICA taxes, there's Social Security and Medicare. There's taxes everywhere. I was in Washington, D.C. one time, and this guy I noticed across from me had a different accent. I said, "Hey man, where are you from?" He said, "I'm from Iceland." I said, "Oh, Iceland. I've heard Iceland's awesome." He goes, "It's great there because everything's free." I said, "What do you mean everything's free?" He said, "Our education's free, our healthcare's free, all public transit." I said, "What are you paying taxes?" He said, 77%. I said, "Brother, that's not free." There's two things specifically about real estate with the moment that we're in. Number one, bonus depreciation. If you don't know what that is, you are robbing yourself and the families that you work with. I did a presentation to a group of tax attorneys and CPAs on the tax benefits of real estate. Tax attorneys and CPAs, and they didn't know what bonus depreciation was. So let me be clear. It's very likely that the team that you've paid to help you figure out how to do stuff doesn't even know what your best asset and weapon does, which is real estate. And I'm gonna unpack this in a second. The second is what's called Section 1250 property. Here's what it means. There are certain real estate properties that you can buy that get a larger tax deduction than any other type of real estate, period. Primarily gas stations, car washes, etc. We don't have time to dive into that, but I'll unpack again this concept here in just a minute. Number two, solar. 2 years ago, Tesla lost $800 billion on their profit and loss statement. You imagine running a business losing $800 billion? But then the government pressed a button and created for them $1.5 billion in tax credits. Just so you know what a tax credit is, it just means they make up something and now you don't owe what you owed. So on paper, Tesla 2 years ago made $700 million, even though they lost $800 million. That's what a tax credit is, and it's available for you. You can use solar on residential properties. Think about your primary residence. You can use them on commercial properties. The government will do this. They will give you money, 32% federal tax credit right now. And then they'll let you take the value of that and depreciate it. Panels, charging stations, vehicles, there's stuff available for all this. Again, I'm rapid firing. I want to get to some other stuff too. Number 3, profit sharing and pension planning. So here's the concept is you take income from a given year. Let's say you made $1 million this year, okay? You wanted to take $250,000 and just tell the IRS you're going to pay them later on it. They're known by lots of names: cash balance plan, pension planning, pension trust, 401k, SEP IRA, solo case. There's lots of different names for them. But all you're doing is deferring your taxes on a portion of your income. Oil and gas partnerships. They said for every dollar that you invest in a US-based, IRS-approved oil and gas partnership, we'll give you a 92 cents on the dollar deduction against your income. Why would the government be incentivized to get you to invest in oil and gas? Is because they view energy independence as a national security issue. They want you to do that. How do I align my personal vision and values with the deductions, credits, and stack them together? That's how you pay the least amount of taxes possible. Proper entity setup. This is a lot of folks make money and just pay taxes on it. But there's better ways: S corporations, partnerships, parent companies, C corps. There's a lot of different ways to make sure you're properly structuring how your revenue comes in. Because just like not all income is created equal, let me say that differently. There are good forms of income and there's bad forms of income. And you, being a sole proprietor real estate agent, is the highest taxed form of income that there is. I want to go back to real estate for a second. Real estate is the only investment I've ever found that pays you 4 ways. Appreciation, tax benefits through depreciation. Somebody else is paying down your debt for you. Imagine that if somebody just made your house payment for you every month. You're creating equity on your own balance sheet because it's going up in value and the debt's going down. You see that? You're spreading equity every year. And then the 4th is positive cash flow. So I want to look at, this is a real example. 2017, President Trump passed the Tax Cuts and Jobs Act. And here's what it said. The IRS has this little black book called the MAKERS system. It's Modified Account Cost Recovery System. Don't worry about it. They classify every possible piece and component in any type of real estate into that book, meaning plumbing, light fixtures, tile flooring, granite countertops, refrigerators, and they assign to it a depreciable life, meaning if you buy a $1,000 refrigerator and stick it in a rental property, they say you can deduct $200 a year for 5 years. What President Trump did is said anything in that little black book that has a 15-year depreciation schedule or less, you can depreciate it all up front into year 1. That's bonus depreciation. What you should be thinking about in your own personal financial life is, wait a second, somebody's going to give me a tax benefit to buy an asset that I own forever, that somebody else is paying down the debt on, that's going to appreciate in value, and I get positive cash flow? This is what wealthy families do. There are 50 different ways to do things like this. This will certainly help you with clients, with selling your real estate, but it needs to help you personally. This is really good. How many of you in here have any form of a retirement account? IRA, SEP IRA, 401k, anything like that? Okay, good. Pay attention. The reason you do that, the reason you put money into a structure like that is because you get a tax deduction for it. It grows tax deferred, which means you're just kicking the can down the road. And then the third reason is, you know, at some point in the future, you're going to have to pay taxes on it. You're just hoping you're in a lower tax bracket or that taxes are lower. Neither of those things will be true, by the way. Taxes are only going one place. We're not going to Iceland levels, but we're not staying where we are. So, you know, there's this brick wall, right? You're like in a glorified prison here in your retirement account. It is the worst type of investment account you can have. The government controls it. You pay a homeowner's insurance policy. Let's say you pay $5,000. You have a total catastrophic loss. The insurance company writes you $1 million check. Do you owe taxes on that? No. So imagine you're invested in the S&P 500 or whatever you are investing in your 401k. Fine, keep doing that. But imagine putting a jacket that says life insurance on it and you still invested in those things. Now what happens? We distribute out, let's just use $1 million. Let's say you have $1 million in this account. You put a life insurance wrapper around it and we distribute that out. So let's be clear. You now have a $1 million taxable event on your personal tax return. You simply go to the insurance agency and they pay the tax bill for you. You said, no way. Yes way. We got tax attorneys around the country that have written opinion letters, IRS reviewed transactions called a qualified plan transfer. You take the retirement account money that you got a tax deduction in on the way in for. It grows tax deferred and you find somebody else to pay the tax bill for it. And oh, by the way, as long as you keep that tax or that life insurance wrapper around it, all the income that you receive from it is exempt from federal and state taxes. These are strategies that ultra high net worth and ultra wealthy families use. There's 6,000 pages in the tax code. 5,973 of them tell you how to avoid paying taxes. A lot of this is new information for most of you. Might have heard bits and pieces. Information is not powerful. It's the application of the information that changes things.
And you said to me, I've been
watching you.
Which made you feel like you?
Knew you.
Oh, how interesting. So he formulated a para-social relationship with us. And in the time that you were watching, I added a lot of
Value.